Good afternoon. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital, and I'm truly honored to be joined by Rick Romano. The man needs no introduction, but he is basically one of the global portfolio managers at PGIM, which we'll get into. For compliance purposes, I have included their disclaimer and disclosures on the screen here just so we can cover this. This is both from the PGIM Real Estate as well as parent PGIM, their disclaimers here on the screen. Obviously, we can share those disclaimers with you. For those that don't know, PGIM manages $1.44 trillion. Of that, 343 billions in total alternatives, and Rick and his team for the real estate side, $132 billion. So clearly, they know a couple of things. Rick is the managing director at PGIM Real Estate. He's the co-head of the head of global real estate securities business. He's in Newark. He's basically straddling a lot of the different businesses at Prudential. He has been around a long time. It's somebody that I've looked up to for many, many years. But as you can see with his background on the screen here, that Rick clearly has got some major skins on the wall. He is. Are you currently on the NAREIT Investment Advisory Council, or were you previously on the NAREIT Investment Advisory Council?
Currently on that as well. Yeah.
I'm chatting with NAREIT about that actually currently. So with that, my goal is we're going to turn off the presentation here. Rick and I are going to have a nice dialogue. We got about 20 questions lined up to discuss. We'll have one slide we'll turn back on to talk about valuation. If you have any questions, please feel free to put them in the chat. Or if you're watching this on a replay, send me a message on LinkedIn, Twitter, throughout one of our channels. And obviously, Rick and I are more than happy to follow up. So with that, Rick, thank you so much for joining us. This is very exciting. Quite an interesting time that we're dealing with here, both in terms of domestic and global real estate. So many big macro headlines that we're focused on, obviously, inflation, tariffs, interest rate, treasuries, FX, all the headlines that you deal with every single day. And it's our goal here basically to frankly, I always like to say, peel back the layers of the onion. Let's go more into it than what CNBC or Bloomberg tells you in a 2-minute segment. And for the viewer, whether it's a retail investor or a sovereign wealth fund that's watching this, again, the fact that you guys manage over 125 billion, you clearly are hearing things all across the globe that I feel like can benefit any investor that's looking at the world of REITs and real estate. So thank you again.
Well, first of all, thank you for having me today. Really appreciate it. Really big fan of what you're doing in terms of the REIT space, and have been, sort of tapped into your LinkedIn for quite some time. So really appreciate the opportunity. So
thank you. If you're looking for a new job, I'm always in the market for a new hype man on tour. So boom, you got yourself a gig. I appreciate it. Well, Rick, let's just kick it off. What can you tell us about what you guys saw from global real estate performance in the third quarter?
Yeah, so in the third quarter, we started to see some improvement and some sentiment changes around global real estate. So if you remember, going back to the second quarter, we were in a time frame where we did see the administration in the US introduce tariffs, and those tariffs were, I think, a lot more extreme than people had anticipated. And it created a lot of dislocation in the markets, including global real estate. So what we saw in that time period was that interest rates had spiked up pretty significantly. We had investors thinking about, okay, could this be stagflation or, just hyperinflation resulting from some of these tariffs? So that created a lot of chaos in the second quarter. As the third quarter rolled in, we started to see a lot more certainty, I think, around what those tariffs may look like, and a lot more negotiation. And so some of those worst case scenario fears were taken off the table around inflation and rates. So the good news for real estate, what we saw in the third quarter was we did see rates start to come back. They had touched at 5% earlier in the year for the 10-year Treasury in the US. We saw that start to get dialed back to that 4% range, 4.25% range. And that's pretty attractive for how the REITs were priced. So we did see the U.S. REITs were up about 3 or 4% for the quarter, which is quite good. When we look across the world, Asia was up the most, and that has continued to be one of the top performers year to date. And we'll talk about the reasons for that. There's several reasons. And then Europe, while it was strong in the first and second quarter, gave back a little bit. So we did see a dial back of what was going on in Europe, because when you looked at what part of their performance was in the first part of the year, it was really due to currency movement, right? So we had seen, I think that, the big movement out of US investments due to the political uncertainty into non-US, that happened in real estate too. So we did see that in the third quarter. So I think in the third quarter, what investors were saying was, look, I feel like we're in an environment where interest rates are stabilizing. We've got, some slower growth. We're starting to see the jobs numbers come in a little bit slower than, or decelerating at least in terms of magnitude of growth. And that's typically a good environment for real estate. And then when you look at valuations versus the listed private general equity markets, they look pretty attractive too. So investors were telling us, we feel like this space is a bit safer. Transaction volumes on the private side picked up. So there's a lot of really good news happening in the quarter, and it did manifest itself in some pretty good returns for real estate for the quarter.
So we obviously know the transparency of the U.S. companies, quarterly earnings press releases, conference calls, the list goes on and on. And I'm lucky to have relationships with a lot of the C-suiters. And I think back to the second quarter when tariffs hit, and I've told the story of visiting with a handful of REIT CEOs around the NYU REIT symposium. It happened like right when that happened. And I won't mention the CEO, but I'm like, so how are things going? It's like, well, David, we can look at this from very simple. We have Liberation Day -1, Liberation Day +1. Over that 3 days, let me tell you something. You know what hasn't changed? My dividend hasn't changed. My earnings haven't changed. In fact, we've signed leases over these past couple of days. But my stock price is down 30% on this headline. What does that stock owner or seller know that I don't know when I'm the one running this company? And I think what a lot of these folks were said was, we got to figure this all out before we can tell you where we're heading. And here we are, as you mentioned, a few months later, and we know where this is heading. Tariffs, that type of stuff is really, I feel like, been a non-event for at least the U.S. REIT guys. You're SL Green, your job's to lease the building. Unless you're building, and in my opinion, and you're subject to higher construction costs because of tariffs on lumber, that's one thing. But you as the landlord, you're not really exposed to it versus your tenants who might be exposed to it. So I feel like it's important to peel back that layers of the onion to really truly understand what's going on at the company level. But you brought up a good point, because I'm curious. You said Asia has been the top performer. So what is going on in some of these markets like Asia or Europe that's leading to this outperformance?
Yeah, sure. So I think part of what we saw was when we looked at relative valuation at the beginning of the year, and you looked at US REITs versus non-US REITs, you had a pretty big valuation gap, number one. Number two, you had a long period of outperformance of US REITs versus non-US REITs. So not too dissimilar to what we had seen in the general equity markets, where we were talking about US exceptionalism not long ago. Now we're talking about debasement and looking at other areas where investors can be exposed. So I think the setup going into the year was quite strong from a reversion to the mean perspective, from a relative valuation perspective. So as we saw, some of the uncertainty around what you just described around the tariff policy, a lot of investors said, what, I think I'm going to take some chips off the table in the U.S., rotate out to other areas within real estate. And that included Asia, where they were looking at Japan and saying, what, there's some real positive things going on in Japan right now. We're getting economic growth really for the first time in several years. We're seeing really constructive changes in corporate governance in a lot of the companies there in terms of the real estate companies. So historically, some of the real estate operating companies there had traded at tremendous discounts to NAV, 30%, 40%, because when people look at the board and the management team, they didn't feel like they'd necessarily take the right steps to narrow or eliminate that discount to net asset value. Now we're seeing real positive change there. We've seen activists come into that space. Elliott's gone into one of the real estate operating companies there. And what that's meant is they've started to do more shareholder-friendly things like selling assets, buying back shares. So I think that's resulted in combination with the economic growth that we're seeing in Japan, which is good for real estate, good for developers. that with the corporate governance strides that have been made have really resulted in a narrowing of that discount to NAV. So that's been a real positive, I think, for Japan. Then also in Asia Pacific, you had a few other areas that did very well. Part of the return, keep in mind that part of the outperformance of Asia was currency. So we did have the Japanese yen in the first part of the year was up 10% versus the US dollar. But even on a local basis, these countries have done well within real estate. Go outside to Australia, some really good opportunities there in terms of, when you look at what's going on in the housing market there, shortages. You have some good companies there that are delivering, residential product into shortages, and a rate environment that's been benign or coming down. So I think that's been attractive. And there's also one of the reasons that non-US or US had outperformed non-US in the past 5 years is this access to non-core property types, right? All of those areas that are secularly growing, like data centers, healthcare, et cetera. We're starting to see that export a bit outside of the US. So there are names now, like in Australia, there's a data center company that's smaller, mid-sized, great development pipeline. That was a really strong performer for the quarter, which caused Australia to do well. So I think there's these options that are now getting exported outside of the US, which are more investable than they had been a few years ago as well. So, really a lot of different reasons to unpack in terms of why non-US versus US this year, but important to be exposed globally. It just shows you that, you need to be diversified. You probably need to be global in this space.
You mentioned about some of the Asia Pacific guys becoming more shareholder friendly, utilizing those tools to be more shareholder friendly. My partner comments that in the past quarter, we've seen 10 US REITs explore options, merge, doing different things, potentially going away. And I think it's 36 going back to when the Fed rate hike cycling started back in March of 22. Yet we've only seen 10 new REITs come to market here domestically. So my question as an add-on here is there kind of like a global M&A frenzy like what we're seeing here domestically? I mean, I know we've seen a couple of headlines out of the UK of a couple of REITs consolidating, but is that something that's prevalent in Asia Pacific?
So I think the common theme is that where we're seeing M&A activity today, it's more in sort of small caps. It seems like there's appetite for smaller bite sizes in the capital markets right now. There's not really that appetite for large scale opportunities. So like I said, we've seen that in the US with several examples. We've also seen that in the UK and Europe with examples of smaller companies that have property types that are attractive to private capital right now. In Asia, we've seen it a little bit, some potential activity around some of the smaller J-REITs where the sponsors end up, acquiring that in the REIT legislation in Japan, a little bit different than the US in that you need to qualify as a REIT. There's an external advisory component. So a lot of times the sponsors will buy out the J-REIT. So we have seen that. Maybe we'll see some more of that. At the real estate operating company level, those are usually the big, larger, diversified companies. A lot of times they are sponsors of the J-REITs as well. So they may be more acquirers than being consolidated themselves just due to their size and their where their capital requirements or thoughts are going forward at the board level.
Now, I know that PGIM does not invest in emerging markets. So I want to go ahead and CYA before I ask you the question. I saw a headline this morning that like the Philippines SEC is enacting more, let's say, REIT legislation to bring it more to shareholders, make it more friendly. We've seen a big initiative in Africa, a couple of African nations passing REIT legislation. Obviously, growth of India and some of these other countries. So I kind of ask a multi-layer question. You've been around the block a couple of days. Those countries that were considered emerging many years ago are not emerging today. So what do you think about from the global investment landscape, thinking about of Philippines, of Thailand, some of these other countries enacting REIT legislation? What could that mean for investors in the future?
Yeah, anytime we see countries, get involved to, think about or forming REIT legislation, we think that's good for the space globally, right? Because that means there's more investable options out there. We do not invest in emerging markets. They're not in our benchmark. And the other reason why we don't really do that is because on our private side, we really like to look for synergies between our private side and our public side in terms of knowledge of real estate, boots on the ground, et cetera. We don't really have a lot of exposure there on the private side. So for those reasons, we sort of stay away. But I would say, to your point, this is good, and I think there's what we've learned over the years, right? We've seen this movie before, as you mentioned, that we've seen countries develop REIT legislation. Sometimes they do it that's in a way that's maybe not too favorable to shareholders. So we do like to see a lot of alignment of interests. So we do like to see the management team fully integrated with the REIT so that there's no conflicts of interest outside of that. So externally advised model is not ideal for us. Then when you look at things like transparency and corporate governance, we're looking for as much transparency as they can provide on the assets. So disclosure around the assets they own, reporting, et cetera. And good corporate governance. I want to make sure that there's a lot of independence on that board where sometimes you don't see that. So I think if these countries get those things right, then the last piece of the puzzle that they have to solve is really liquidity. And sometimes when you're in a smaller market, an emerging market, there may not be ample liquidity for investors to get involved. And that's another reason why we typically don't get involved in emerging markets, is that sometimes those names just aren't that liquid for us.
A shameless ask. When PGIM does decide to put boots on the ground in like Maldives, the Seychelles, or Fiji, will you give me a call? I'd like to apply for that position, please.
Well, I may be long retired and sitting on a beach in Fiji, so I'll try to give you a call from there.
You'll be running the operation in Fiji. All right, so let's narrow the focus a little bit. We're going to take this from both the domestic picture and the global picture. All right. So what sectors are standing out to you guys right now? And then maybe if you could share, because again, I know, let's say senior housing is different here in the States than it is in the UK versus Asia, as an example. But what about some of these big popular sectors that we hear all the time, such as, I call it data, you call it data centers, retail, office, industrial. Maybe walk us through some of the sectors that stand out to you guys.
Yeah, I think, there's a few sectors that are really attractive right now. You did mention healthcare and assisted living specifically in the US. Healthcare is broken down between assisted living, medical office, skilled nursing, et cetera. The area that we like, where we're seeing really good earnings growth at the same property level, and certain companies that are able to go out and acquire, use their balance sheet, get really good external growth, is on the assisted living side. And you're right, it's very different due to regulations globally. So there's really not too many great options to play it outside of the U.S. listed companies, and they do have some exposure, directly in their portfolios. Some of those companies do have holdings outside of the U.S. However, in a direct listed environment in Europe or Asia Pac, there's not great ways to really access that growth, and the growth profile is different, with the exception of Canada, where we have been involved there too. So what do we like about that business? Obviously, you see the demographics, the population's aging. I think we're all pretty familiar with that story. You have occupancy levels that are still in an upward trend for senior housing, and you have some of the cost pressures that we saw a few years back starting to mitigate. The main one being really wage inflation for healthcare workers has moderated. So that's resulted in us seeing, significant growth in terms of same property NOI growth on the healthcare side. We have to be mindful of valuations, but we think that there's a pretty identifiable tailwind of demand there that's very defensive. So it's not really going to depend on things like jobs growth and what goes on in the economy. A lot of this is needs-based, focused on where demographics are. So that's pretty attractive to us in this environment. When you get outside of that, data centers is another area where, again, you see growth within REITs. So what we look for is mispriced growth, and we still think there's pockets of that in both healthcare and data centers. Data centers, interestingly, have not performed that well this year relative to the rest of REITs. They still have great demand tailwinds that we've seen. And there are ways now, increasingly ways, to get involved outside of the US that have done pretty well. So when you look at the fundamentals and you look at the supply picture, it gets pretty exciting in terms of two things. When you look at hyperscale portfolios where leases are rolling over, you're seeing, pretty good mark to markets on those leases. So good internal growth for the first time in a long time. We haven't really seen that much in data centers recently. But also a real valuable asset for these companies to have is land that's entitled and has access to power. And in particular, if it's close to high fiber, low latency type markets, that's very attractive. And so you have all these hyperscalers that you hear about every day on CNBC who are looking to place capital and build data centers. And they would do them in many ways. They would do that like on their own balance sheet if they can, but they may not have the land, they may not have the access to power. So they need the REITs that have this valuable asset right now to put in production as quickly as possible data centers. So I think that's a good theme. We're seeing that in the US, Australia, I think, and even Europe. There's a company in Spain that has a good pipeline of entitled land with access to power. They're more of an office company right now, but we're starting to see that transformation. Companies like Prologis too, they just put out, their plan for a pretty big data center expansion. So we think that, this doesn't last forever, but we do like where it is right now. Let me pause there, but I'll get into some of your other property types as well.
Well, you mentioned Prologis, and my mind's going a mile a minute.
Yeah.
I'm not asking to talk about specific companies, okay? But when you mention Prologis as a global PM, I also think about guys like Equinix, Digital, American Tower, the REITs that really, yeah, they're based here domestically, but they have a global footprint. So my question is, not talking company specific, but indirectly company specific, does that complicate the picture as a global PM? Because Prologis may be doing well in this country versus that country, and therefore we have to value it differently in Asia versus what we value it here. Or somebody like an AMT or an Equinix that's big in Africa. Again, I know that you guys aren't invested in Africa, but if you own the stock, they're indirectly invested in Africa. So again, I'm just kind of curious, does that muddy the picture a little bit?
I think it's a good point. I think it creates opportunities, really. So if you're a global manager with boots on the ground in many of these markets, you do have that on the ground information for those markets. So I think you can underwrite some of those non-US markets a bit more thoughtfully based on, again, when we think about real estate, REITs are very transparent, but private real estate isn't that transparent because most of it's held privately, right? So, commercial, institutional quality real estate, most of it's held privately, only 5 to 10% is listed depending on where you are in the world. So you have, these companies like Prologis, like Digital, that have a lot of non-US investments, and the peer set information isn't necessarily in the public markets. A lot of it's in the private markets. So for us, I think it's a good advantage. And you do, to your point, you do have to underwrite those and look through the property markets that they're in and what's driving rent growth. Fundamentals might be very different in Asia than they are in the US. So having an understanding of that can really help you understand what companies might beat earnings or miss earnings based on what's going on in their non-US portfolios. It's really important to have that global view when you look at these companies.
You spent some time, I believe, talking about employment growth. We had now granted, we've got a boatload of jobs data that still has to come out, all right? But we did get a fairly rosy September jobs report this morning, although I believe the unemployment rate did tick up on the overall.
Yeah.
So my question, again, thinking about both domestically and globally, it might sound like a dumb question, but I'm curious for more insight. How do you see employment growth benefiting the REITs?
Yeah. So definitely for the REIT sectors that are more traditional, less defensive. So when you start to go outside of needs-based healthcare, you go outside of data centers to a certain extent, and look at areas that traditionally are job dependent within real estate. So you've got office clearly, right? Looking at office using employment, and then apartments too. Anything sort of housing related typically has a pretty high correlation with jobs growth. So for REITs, though, I think when you get into that environment where you have jobs growth that is growing but maybe not that strong to cause inflationary pressures, typically, if you have a slower jobs growth environment with a stable and declining rates environment, that's been good for REITs, right? So if we look at apartments today, I think it's a good example. The cost basis of getting into listed apartments right now is very attractive. You've got companies trading at six and change implied cap rates, and the private markets, we're seeing deals in the low fours, high fours. So that level of disconnect, as you know, you don't see that often in apartments, which typically trade pretty close to par to NAV. So, it seems like the market is saying essentially that the listed market, number one, we're not quite that happy with what we saw in the second and third quarter earnings reports for apartments, because we're expecting perhaps a little bit more of a bounce back and improvement in revenue and rent, number one, but also some overhang about jobs, like what is happening with jobs going forward. Is AI going to impact jobs? And then some of the demographics around the population growth in that sort of historically higher renter segment of 25 to 34-year-olds, that's really not growing that much. So we look at all of that and say, you know what, even if you get into a job slowdown or recession, at the cost basis you're in apartments, they still look pretty attractive. So if you're a patient investor, we think that's a good way to look at somewhere where you don't necessarily need something that's historically depending on jobs growth that seems to factor in a scenario that is not that robust for jobs growth where you can take advantage of. And then office is, sort of a different story in each market. We could talk about that separately.
We've touched upon tariffs a little bit. Do you see tariffs continuing or impacting the REITs both domestically and globally going forward?
Well, I think the good news about tariffs was that, this crisis around tariffs that we had in the second quarter, it was really the first crisis in the last three that real estate wasn't directly in the crosshairs of, right? So if you go back to the GFC, that was real estate credit. COVID was, how do we live, work, and play? But tariffs, not really directly impacting real estate that much because, what you touched on before, real estate's a local business driven by local supply and demand. Now, obviously, there are areas that touch on that. The biggest direct area was industrial. And we did see leasing decisions in the second quarter get put on hold, and we saw less traffic around industrial and the ports. So we did see some direct impact there. That seems to be, like you said, we sort of have a clearer picture now. That seems to have resolved, and we're seeing leasing decisions being made on the industrial side. And then some of the the other area that would probably be most impacted, not directly but through the tenants, would be retail. So how are they impacted? We've seen some retail reports already, this quarter where they've pointed to tariffs as being an issue for their business. So just really globally, just monitoring the credit quality and how these tenants are doing in this environment. I think you need to be pretty prudent about that. But overall, we don't think there's going to be a huge impact here.
That's interesting because we were talking before this about, the landlord, their job is to lease the space. It might be their tenant that is impacted by that. But hearing you talk it out, it makes sense then why a Simon or a Tanger might be concerned about tariffs because of the fact that, again, let's say a Coach luxury outlet might have to raise the prices on a bag because of the fact that there's a tariff implemented. And granted, that Coach outlet probably isn't going to go away, but sales per square foot may go down, blah, 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 because of that. So that's really very insightful. I appreciate that. All right, let's talk more about you. Or let's talk more about PGIM. Because of the fact that you guys are pretty tiny, being a smartass, but in all seriousness, you invest in public, you invest in private, you invest domestically, you invest globally. What is your approach to investing in both the private versus public markets?
Yeah. So on the private side, we've got, different segments based on investor appetite and risk. So we've got core strategies, core plus strategies. And, those are areas where investors are looking to have access to a diversified group of real estate and look at a good income return and sort of a stable dividend over time. So we use partners to access that. So we'll look at the best operators and developers in the world. Sometimes those include REITs to be involved with them. And, very focused on research-driven property types and picking good partners in real estate in those segments. We also have a big debt side too. So we have a big mortgage lending group, which also informs us on the listed side on what's going on in the capital markets. And, when we look at the debt capital markets, we think they've improved significantly, this year, where we're looking at the different constituents that are typically involved in lending. We see global banks back, we're seeing regional banks back, we're seeing the CMBS market come back. So I think, we're getting a clear picture from our private side, but also what we're seeing in the market, that spreads are coming in, there's capital available there, and that's really good news for REITs in general. When you look at our listed business, our public business, I think we view ourselves really as a listed real estate manager that's sitting inside a large, diversified global private REIT. And we have access to all of that information that they have on their private side. So that gives us a pretty good competitive advantage on not only things like, where you think real estate values are going, rent trends, but, where the debt market's going, management teams, importantly. So we may be a lender to some of the REITs globally. We've certainly probably sat across the table and bought and sold property for them. So we understand what risks they might take and how thoughtful they are, or who are the better developers and operators in those markets. So a lot of synergies. And beyond that, if we know where our private real estate group is investing capital, that's really important for us too, right? So if we know one of the largest investors in the world is putting money into manufactured housing, as an example, in the US, you know what? Cap rates in manufactured housing are not likely to go up. They're more likely to go down. Gives us just an additional layer of conviction. So we do a very thoughtful proprietary real estate NAV analysis. And then what we do beyond that is we make adjustments to get to a target stock price. And they include quality of management, corporate governance, external growth opportunities, liquidity, overhead as a percentage of gross asset value, all of those to get to the target stock price. So I think there's so many synergies for us to have public and private and debt. We look at real estate as real estate, and the wrapper is just public, private, equity, debt.
So much to unpack there. Some great comments. Boy, it'd be interesting to be, like a fly on the wall in your NAREIT meetings with some of these management teams versus my one-on-one with some of these teams. I can only imagine what that must be like when PGIM walks in to chat with some of these big boys. You talk about the debt markets because, it seems like every single day over the past 3 or 4 months, at least one REIT or real estate company has pulled off some type of debt deal. And as I mentioned, I was on Bloomberg TV last week, thankfully, and I mentioned that you're a REIT. The lending window is about as wide open as it's ever going to be. It is so easy to take down money right now. Basically, it's free money. I don't want to say free money, but you know what the range is. You're credit rated. You know what you're going to be able to borrow 5, 7, 10-year paper at. It's not like it's changing that much on a day-to-day basis. I want to share the screen because it leads into the next question that we briefly talked about, and that's talking about relative valuations, looking at S&P versus private. So I wanted, I'd like to shout out NAREIT. Thank you, NAREIT, for posting this great note this week. We borrowed your little chart here. So Rick, based off of what you're seeing and what NAREIT is telling us what we're seeing, what's your thoughts about valuations in the current market?
Yeah, I love this chart, and I'm happy NAREIT did this because these are the exact conversations that we're having with investors right now. And that is that, they're looking at their general equity exposure, they're looking at technology, Mag 7. They've had a great run over the last several years. And, valuations are looking, relatively rich versus history. And so one of the conversations that we're having is, they're thinking about rotating out of some of this growth in the S&P 500 into areas that propose more value. And when you look at REITs in particular, they've underperformed the general equity markets for the past 5 years or so. The relative valuations, as you can see on this chart, are very attractive relative to the S&P 500. In fact, there's only been a few points in time, going back to the GFC, where we've seen this level of disconnect. Today, we currently sit at the multiple of the S&P 500 being roughly 1.3 times what the price to cash flow multiple is of equity REITs. And historically, whether that's happened in the GFC, you could see the big spike there. That was the first quarter of '09, where we went up to about 1.7, or even for a period of time during COVID, we went up to the 1.2, 1.3 levels. Each of those times, if you roll forward on a 12-month basis, you had significant outperformance of REITs relative to the S&P 500. So I think this is what a lot of investors are focused on. And what we're seeing is traction in terms of when we think about flows this year into our real estate securities business. We have net flows, which includes retail, net flows of about $400 million, and then identified but not committed, committed but unfunded behind that of another 225 million. So it's starting to resonate, I think, the relative valuation story, particularly when you combine that with the fact that, okay, maybe we have some clarity on the rates picture now, and the debt markets are wide open, so we get better transparency on real estate pricing. We expect the transactions market to continue to pick up on the private real estate side. That's just more transparency where people can validate that, what, not only are we, look attractive relative to the S&P 500, many of these companies look really attractive relative to private real estate right now. So, and then people look at the supply picture in 26 and 27, get even more excited about the opportunity here. So a lot of, what were headwinds a few years ago, turning to tailwinds in this space, and valuation, relative valuation is definitely one of those.
I think as my partner told me, if we go back to the Fed rate hiking in March of 22 to today, REITs have underperformed the S&P by like 70%. Yeah. And yet, going back to the global financial crisis, it was only about 20%. So we're frankly in some unprecedented times right now with what we're seeing in the industry. So besides all the jet lag from all the traveling, crisscrossing the globe that you do, what keeps you up at night these days?
So, I think there's probably more stuff that kept us up at night, going back 6 months or so ago, because we still had even, to the second quarter, uncertainty around interest rates. We had a lot of interest rate volatility, uncertainty about U.S. policy regarding tariffs. So now it's really, what are some of the macro or geopolitical unknowns out there? So we do worry about, any tensions globally that would escalate. That's going to have a negative impact. But, we do worry, long term, what is going to be the impact on AI on everything? How do you sort of think about that from a jobs perspective, from a real estate footprint? All of those things I think are, important to think about. And then, just looking at the credit markets, making sure that what's happening in the credit markets is thoughtful and disciplined, and that people don't get too extended in terms of lending credit. I think those are the areas that we're probably focused on right now. But like I said, a lot of stuff we worried about has started to turn into tailwinds now. So we feel really good about, 26 in terms of, how REITs shape up on a relative basis.
Well, you just threw those crumbs out there. So let me ask that question. What is the value proposition of investing in both domestic and global REITs in 26 and beyond?
Yeah, so I think you've got, really good valuation cost basis here relative to private real estate, relative to general equity markets. So you're starting with that. You've got an interest rate environment that for the first time, since you mentioned really in 2022, is looking a lot more benign. And, it's likely to be at least the short end, declining. And we've seen the 10-year come in as well. So I think, when we look at those factors, they've historically been really attractive for REITs. And then the supply picture is really gets interesting as we start to roll forward into 26 and 27. We've seen supply added in some markets that's being absorbed, like Sunbelt apartments, for example. We still need to work through a little bit of that. But when you think about starts that had occurred, the last few years, given how we've seen inflation and materials and labor and land values going up, to really start something and assemble it today or a year or two ago, it's really hard to justify a build there from a rent perspective. But also, you didn't really have a lot of bank lending going on for construction financing in the last few years. So I think we're going to see that in a lack of new supply across a lot of property types in 26 and 27. So when people look at all that and they say, okay, you've got a dividend yield of this space of 4 or 5%, you've got, in the US, 26 growth rate for REITs somewhere around 6% or so. You look at that, if you don't see an expansion or contraction in the multiple, and you don't have to do a whole lot, right, to get to a 10% type return. And, in different parts of the world, it looks even a little bit more attractive when you look at parts of Asia Pacific, for example. So, I think, I think people are going to look at 26 and say, could be a transformational year in terms of this maybe is what non-US looked like last year in the general equity markets. Maybe REITs look like that relative to the general equity markets this year, where it's been underallocated to, it's been ignored, but the valuations and the fundamentals look so attractive, and people want to diversify and take some risk off the table in their general equity portfolio and start rotating. So I think that's the base case thesis.
So I have one more question, and if anybody has any questions to ask Rick, please feel free to put them in the chat, and we can touch upon it. But my last question would be, what one piece of REIT investing advice would you share with the audience if you wanted to share some wisdom?
I would say, have a REIT allocation, right? I think everybody should, think about in portfolio construction, you've got equities, you've got bonds, you may have some alts, but there is a place in your portfolio for a 5 to 10% REIT and or private real estate allocation. So whether you're an individual, whether you're an institution, if you look at that allocation gives you, some characteristics of a bond, right? It's like a hybrid investment. So you have the dividend yield, which is income oriented like a bond. But then you have equity characteristics too, right? Because that dividend grows over time as these companies increase rents and raise cash flow or increase cash flow. So I think it's important to have this asset class as a diversifier in your portfolio. And when you look at what it's done historically relative to stocks and bonds, it's proved to be a good portfolio diversifier, and it's added really improved investors, spots on the efficient frontier by doing that. So I would just say, have an allocation to real estate, have an allocation to REITs. You'll sleep better at night because your portfolio will be more diversified, and you'll have access to something that's got stability in the dividend and then some growth components through rent growth and cash flow growth.
Well, Rick, here's hoping when we speak, hopefully a year from now, when we revisit this conversation, we're going to have a 10-year Treasury handle that starts with a 3. We'll hopefully have a Fed funds rate that starts with a 3 or something. We'll see the RIMs trading at 1,400, and it's going to be REIT frenzy because everybody's going to be embracing our sector again. I can't thank you enough for sharing your time and wisdom and experience with us. I've walked away with so many interesting takeaways and frankly, so many more questions, but hopeful that we do see sentiment start to improve. And on behalf of everybody watching this, I really thank you again for spending your time with us today.
All right. Well, thanks, Dave. Yeah, I really enjoyed being on. So thank you for the opportunity.
Thank you. Stay with me 1 second.